Hey Samfam, this is Ria from Samaya. Case scenario 11. ABC Limited is engaged in trading of garments and it had a warehouse at Kochi where the total inventory value in the Kochi warehouse is less than 1% of total inventory value. So the auditor thought that it was not material, so he didn't check that and relied upon management's internal inventory confirmation and warehouse keeper's stock register without verifying the actual count. Now, in the same year where they have relied on warehouse keepers' stock register, they found some differences between the stock register and books of accounts balance. And what they have done, they have wrote it off in miscellaneous profit and loss account, which is immaterial. And the next year, while performing analytical procedure, what is analytical procedure? Comparison of financial information to another non-financial information. The auditor found a significant reduction in sales and increase in number of invoice cancellation and sales returns, and a spike of that is increase in freight charges also. And how the inventory that were lying in Kochi was 4.5%, which is some significant amount. So that auditor had done some audit procedures, and with that audit procedures, what did he do? He inquired the periodicity of physical verification at Kochi warehouse. The management gave the response like physical verification. This is like an inquiry. How could the auditor obtain sufficient appropriate audit evidence through inventory observation, reperformance, recalculation, right? He inquired the management. The management gave that physical verification takes place every 6 months. No flaw with that. Internal control was good. And because of flow operation, the warehouse keeper himself do invoicing and dispatching the goods. The segregation of duties were not there. So this is a flaw in internal control system. Monthly invoice details to along with the monthly stock register is sent to HO. Internal control was good here. Further, this year too, there's a substantial difference. Last year they have adjusted in miscellaneous profit. This year they have a substantial difference. So the auditor visited the Kochi warehouse and conducted the root cause analysis, where he found that the goods received on sales returns were registered in the stock, but that the goods were not physically there. So there might be a fictitious sales returns. So, in the view of the above case scenario, which according to you is correct statement, only the errors can be expected. No, auditor has to find out all misstatements, frauds, errors during the audit. Only statutory compliance is expected to be. No, that is on compliance audit. In statutory audit, not only that, he has to form an opinion that the financial statements are materially free from misstatement or fraud. The auditor contents that the last year the inventory levels in Kochi was not in the sampling materiality level, is less than 1%, so he withdrew. So this is the correct statement, as this is an inherent risk. Audit risk consists of three risks: inherent risk, control risk, and detection risk. As there is an inherent risk of audit, so he couldn't find all the frauds or the misstatements. Option C is most appropriate answer. Which components of audit risk are represented A4 scenario? Inherent risk, yes. Control risk, no. Control risk were more or less 80% were good. Detection risk, yes. He couldn't able to detect the difference between the stock register and adjusted in miscellaneous P&L account. So option B is most appropriate answer, as he couldn't able to detect them, and control risk also. Now we'll move on to 12th case scenario. First one. How should the auditors of Q Limited deal with the matter relating to non-receipt of declaration under section 164(2)? 164(2) is, have you remember something in company law, like with regards to disqualifications of directors, right? Yeah, disqualifications of directors, they haven't given the declaration that they were not disqualified to be appointed as a director. Now, what the auditor has to do? The auditor may perform alternate audit procedure. No, that's a straight cut option with regards to compliance. If the auditor has been able to verify all director except one, you could be ignored. No, everybody has to submit. There's no reporting implication. No, there's reporting implication. Auditor would need to report this matter in the main audit report. Yes, he has to report under the heading other reporting responsibilities under section 143(3)(f) clause F, where the comments on matters that have adverse effects on the company. If they hadn't submit any kind of disqualification with the auditor, there's something fishy that's happening in the company. And second question is, how should the auditor of Q Limited deal with matter relating to erosion of net worth of RPS Limited? What's that they are talking about? Q Limited gave advance of 50 CR. its turnover is 400 CR and it had given 50 CR loan to its subsidiary, that is of 12.5% of its annual turnover, which is a significant amount. On 2017, for carrying out a certain project, and the net worth of that subsidiary had been eroded. And looking at the future of projections, there are no uncertainty, that is no going concern for that subsidiary. So we cannot recover back our advance amount also. So in respect of Q limited, there is no reporting implication. No, that's a significant amount auditor has to report. In respect of Q, auditors would need to give emphasis of matter paragraph. You see, emphasis of matter paragraph is something that was in the financial statement. We have to write it. See all the circumstances or going concern or the future viability or the going concern concepts are something that were non-financial nature. So we cannot use emphasis of matter paragraph. If these two were wrong, we could go with B. In the respect of Q, auditors of Q would give qualification in respect of non-recovery of advances. Yes, they have to give because it's a substantial loss for the Q that could significantly affect the operations if the adjustment entry is not recorded in the books. Yes, option C is most appropriate answer. The auditors would need to be include a note doesn't serve for the purpose. It's a significant matter. Option C is most appropriate. Do you agree with the way auditors have handled the matter relative to non-compliance? They have non-compliant few FEMA regulations, then they are saying that management had action plan that they have initiated on the basis of management sure that non-compliance would be done good. That is, no penalty would be there in future. And the auditors have evaluated this matter involving regulatory matters expert. Yes, very good. They have used auditor expert and agreed with the management review. What the management is saying that they make good and no penalty would be there. So we'll see the options. The auditor didn't handle. No, they handled appropriately. The management would need to include the matter in notes to accounts of the financial statement. Yes, they could do that. And they could have handled the matter in a better solve involving a tax dispute because it might result in a penalty that may have some taxation impact. That's not with regards to tax or tax handling. That's with regards to penalties and also option D is not most the appropriate answer. Q has preparing CFS and did not consider it SPS. But this is because the financial year of SPS is January to December. You see, Q has what? It has had turnover of 400 CR, so it would follows what? In days. So if in our time limits part 1, what we have discussed is that if the time cap is for 6 months, they have to consolidate if it's a AS. And if they could make some adjustments and all, they have to do that. And if it's in days, that is 3 months. Since it's December and our financial year end is for the March, so we have to do consolidate that. For that, QRP needs to prepare CFS and also consolidating. In this case, it's not done. The auditor need to qualify the report. You see, consolidation of a subsidiary is a significant matter. So it affects all the it affects its material and it affects all the account balance or class of transactions. So it's pervasive matter. So it has to give a qualified opinion with regards to that. Option A is most appropriate answer. Actually, they have to give an adverse opinion since we didn't find anything here with regards to that. We have just gave our appropriate answer, most appropriate answer to qualify the report, not giving an unqualified. Do you agree with the view that the auditors of QRP is not testing IT controls in the first year SAP? Okay, they have implemented some SAP and they did not test that IT controls because it's first year. They have to not do that because all the reports that were prepared by the SAP itself has been audited by the auditor, right? How could he not test those IT controls? He has to test that. The auditors need to perform procedures, yes. Option B is most appropriate answer. Auditor may have priority on basis of the view. Auditor would need to document. Precedence here is priority, so everything was like not appropriate. Option B is most appropriate answer because to perform the procedures forming any view. Now we'll move on with 13th case scenario, where the first question. Though the company had significant growth in past years, it did not perform well in last 2 financial years as per SA 570 going concern. There were few certain events and conditions that individually may cast significant doubt on going concern. In order to assess whether the company is going concern or not, what are the audit procedures should not be performed. Since they are asking should not be performed, we'll see what all should be performed. Analysis and discuss with the management of the company to find out whether installation of new plant and machinery would enable the company to reduce cost of production. If they are reducing the cost of production, they are reducing the cash outflow, so increase in working capital. So they could going concern would be not affected. So option A is the audit procedure for the going concern. Inquire the company's legal counsel regarding the existence of any legal litigations or claim against the company and reasonableness of management assessments of their outcome and estimate their financial implication. Yes, this is a very good audit procedure that any kind of penalties would wipe away the company. So this is a audit procedure which have to be performed performing the while evaluating the going concern, evaluating management future plan and strategy, and to increase the market share of the product. Yes, obviously they are increasing the share of the product, so increase cash inflows. So it would be helpful for the going concern concept analysis and discuss the company's cash flow and profit of previous years with projected account. It's mostly like standard costing. It's like comparing budgets with actuals. This doesn't serve for the purpose. This comparison doesn't serve for the going concern. So these are the audit procedures that need not be performed. Option D is most appropriate answer. Of second question, company has made an estimate for relevance of debtors at the rate of 5%. That is provision for bad debts, I think, as they can only be estimated. So an accounting estimate varies widely with their affects the degree of estimating uncertainty. And with that said, please advise which of the following may have higher estimate uncertainty and higher risk. Okay, which of these have high risk? Judgments about outcome of pending litigations with some company against the company is high risk. Obviously, litigations were of high risk, all the non-compliance. Option A is most appropriate. We'll see the other. Inventory obsolescence, that was frequently made and updated. When any procedure was frequently made and frequently updated, it's lower risk. A model that was well known and assumptions to the model are observable in the marketplace, lower risk, right? Since it is the same throughout the industry, it has low risk. Accounting estimate made for relevance of doubtful debts, where the estimates made in the prior period do not indicate any substantial difference between original and the actual. Since there was no substantial difference, it's also a low risk. So high risk is with that the litigation. Option A is most appropriate answer. Third one, the company is in notes accompanying its financial statements with regards to some suit that was filed against the company, and based on that, it is necessary to draw users' attention to the matter presented in the financial statement. If you read the statement, emphasis of matter of paragraph has to come to your brain. It says 706. In this situation, which of the following reporting option would be correct if the auditor is satisfied with the conclusions reached management? And this, you see, the auditor is satisfied with the conclusions reached by the management. So a clean report, and this matter is fundamental to the reader of financial statement. We'll see the emphasis matter paragraph here, or definition. A paragraph is included in audit report which was presented disclosed in the financial statement, and it is as per auditor's judgment, it is fundamental to users understanding of financial statements. So it has to be in emphasis matter paragraph, and issue a qualified report. No auditor is satisfied, he have to issue a clean report. Include emphasis matter paragraph, and relevant disclosures and describe the matter can be found in financial statement. Option D is most appropriate answer. Company got a show cause notice as per SA 250. Auditor shall perform audit procedures to help identify the non-compliance with laws and regulations, and what not the audit procedure to be performed. You see, what have to be performed with regards to the non-compliance? Understand the act. Yes, we have to understand the act and the possible effect on the financial statement. Yes, discuss the matter with the management. Yes, if they do not provide sufficient information, they should obtain a legal advice. Yes, monitoring legal requirement and compliance with code of conduct, and ensuring that operating procedures are designed to assist prevention of non-compliance. You see, this is mostly like internal audit. We are doing audit of the internal controls and all, but we are doing audit of compliance, whether the company is complying with the laws and regulations, not the company is doing the internal operating effectively as per its code of conduct or with the internal controls that were designed to prevent non-compliance. So this is an internal audit. Evaluate the implication of non-compliance in relation to the risk assessment and reliability of written representation and take appropriate option. This is also a compliance audit. And so option C is an internal audit one, which would not be done with regards to compliance audit. Fifth question, the company had availed some amount of loan to buy some plant and machinery of 25 lakhs, and it want to purchase machinery oil extracted, but purchase some improved model including oil extractor, including dryer. They have bought the plant and machinery for the same purpose only. So in the Caro, it was not utilized for acquiring machinery. No, it was utilized. The machinery was bought. Ask the management change in terms, and if the management do not agree with, ask the management to change terms and condition of term loan. Has acquired different machinery. No, the same machinery but a latest version. It is same as oil extractor. If you have bought some chimneys and all, that's a different machinery. But they have bought the loan for the borrowed loan for the oil extractor, and they bought oil extractor only. State the fact that the term loan taken was applied for the purpose. Yes, option C is most appropriate answer. Now we'll move on with the 14th case scenario here with regards to some nationalized bank. And first question is, which of the following statement is true as per given situation with permanent consolidation adjustment current period? We'll see those adjustment here. Some adjustment given with effect of merger. Determination of goodwill, it's a permanent one. Determination of minority interest is also permanent one. That is done only at the time of in a merger that was happened only one time. These were permanent things. Intragroup transaction adjustment account is 15 lakhs. That was done yearly basis, so it's a current period. And harmonization of accounting policies between subsidiary and holding company is also done every year for the account to harmonize the accounting policies. And these were the current period adjustments. The 15 plus 30, 15 plus 30 is 45 current, 2.5 CR permanent, 2.5 lakhs permanent adjustment, and 45 CR. Option A is most appropriate answer. With regards to that, while verifying the compliance of corporate governance, regulation 17 and 17A, with regards to the composition of the board, what the board consists of. With regards to here this is about the thing. The company had 12 directors, including 3 women directors. Out of them, Mr. Wright was non-executive chairman and is also a promoter. And they have 5 independent directors. When, as per regulation 17 and 17A, if the chairperson is non-executive and he's a non-executive chairperson is a promoter, then at least half of board should be independent directors. So since there have to be 6 independent directors, but there were only 5, so they did not comply with that. So no, and it's up to the shareholding. There should be at least half. There should be at least that is 6 independent directors. Yes, there is a non-compliance. Yes, there is a non-compliance. Option B is most appropriate answer. List down all the months whose date has been selected inappropriately by Mr. Das in calculation of SLR compliance. What all he has done. 12 audits in different months. Okay, other than Fridays. That was discussed in our time limit, because why it is other than Fridays is because all the on Fridays SLR has to be met and report has to be given to RBI. So anyways, banks make sure that on Friday it gets it had meet that. So what the auditor has to do, auditor has to check other than Fridays, what are the SLR requirements or DTL requirements, etc. So what all the Fridays here were not correctly chosen by October, June and July were not appropriately checked by the chartered accountant. June, July, October. Option C is most appropriate answer. While calculating SLR, what will be the DTL? What is the DTL here? Yeah, on March, this total liabilities to 200 CR. It includes margin held by funded facilities of 3 CR and a credit balance of branch 4 CR. You see, credit balance of a branch could be included. Adverse balance in nostro mirror accounts can also be included, but unadjusted deposits should not be included. They have to be excluded, and margins held by funded facilities also should be excluded. We'll see here. Yeah, this is with this is a snap from our bank audit. Exclusions is with regards to unadjusted balances and margins with regards to sundry deposits. And if it could include net credit balance and adverse balance in nostrum error account. So this 3 and the 6 here should be excluded. So the total is 191 CR. Option A is most appropriate answer. Will Mr. Das will be disqualified as his wife purchased 100 shares for 15 lakh. You see, relative bought with a face value more than 1 lakh. He should be disqualified and have to maintain a corrective action within 60 days. So since she purchased 100 shares of rupees 100 each, this is the face value. 100 into 100, 10,000. So it is below 1 lakh, so no disqualification. So not disqualified as the market value, no, not the face value. Yeah, less than face value. Option C is most appropriate answer. Now we'll move on to the 15th case scenario here. First one, what is the minimum solvency margin for an insurance company? You see, the insurance company's minimum solvency margin is that assets were half of the capital, paid up share capital. What is the minimum requirement of paid up capital for an insurance company? It's 100 CR. Yes. For that, 50% is 50 CR. So option A is most appropriate answer. And what could be the possible reasons for the objections raised by the shareholders for a listed companies? Yeah. Some auditor had been resigned due to some personal reason and the board had replaced the casual vacancy within 30 days. That is right. But they have to take shareholder approval within 3 months. Yes. Where is that? 3 months. Yeah, here. Option D is most appropriate answer. You see all the monetary limits that were discussed here and the time limits were all was discussed in the time limits part 1, I think. Do check that out in order to have a quick brief about that. Looking of the above appointment, what is the appropriate interference which can be made about the professional ethics of Q&S, that is the newly appointed auditor. They have, okay, what did they have done? The firm also accepted without communicating the same to the previous auditor. You see, as per SQC1, they have to make the approval or intimate the previous auditor, right, with regards to the professional. Otherwise, they would be liable under clause 8, part 1, first schedule. Option B is the most appropriate answer. And 14th one is whether CARO is applicable for this private limited company for what? Statutory order of private limited company having paid up share capital 112 lakhs and a negative balance of 15 lakhs. You see, in order for a private company to get CARO applicable, its total revenue has to be more than or equal to 10 CR. As soon as the total revenue touches 10 CR, CARO is applicable. Or paid up share capital plus reserves and surplus touches 1 CR, CARO is applicable. Borrowings, when it touches 1 CR, CARO is applicable. See, 112 minus, that is the negative balance, right? Minus 15 is 97, which is less than 1 CR. So CARO is not applicable to this private limited company. So no, CARO is not applicable as the paid up share capital and reserves do not exceed 1 CR. Option D is most appropriate answer. Now we'll move on to 16th case scenario here. First question, in respect of the fraud identified by the management. Okay, management only had identified the fraud and what the reporting implications in part of the auditor. What he has to do, he has to report that report it in the auditor report. Auditors would need to report the fraud in CARO. Okay, if CARO is applicable, he also report into CARO. Further, they also need to evaluate whether they report on internal financial controls and main report and should be qualified or not. Yes, it should be qualified or not. He has to check with regards to the materiality and all. So option A is stands good. Second thing, considering the materiality, auditor may consider not to report. No, fraud, if it's a fraud, he has to report. But qualifying or not qualifying the audit report depends upon the materiality. Auditors would need to qualify? No. Auditors would need to qualify their main report. There is no need to qualify the report, but there is a need to report the fraud because fraud has need to report. Qualification depends upon the materiality. Option A is most appropriate answer. Second one, the management of the limited did not carry out physical verification for the inventory. What could be the reporting implications on the fraud of on part of tax auditor? You see, they did not do the physical inventory calculation. What the tax auditor has to do? Since the tax auditor and management both did not carry out physical verification, very good. The tax auditor should report on basis of statutory audit report and last audited period. No, how could he uh, rely on some statutory auditor or last audited period. He has to perform some alternative audit procedures. If had not able to perform those alternative audit procedures, what he has to do? He has to qualify his opinion. And we'll see second option. It is common practice to appoint tax auditors after reporting a year. After that, rollback provisions have to be done, and no reporting, no. Since carrying out physical verification is preparing financial statement is a responsibility of management. In that, this is also a responsibility of management to carry out physical verification of inventory. Since they have not done that, he had to report. There's no chance that no reporting has to be here. Also no reporting, this is also wrong. We'll see option D. Since tax auditor did not perform the physical verification, tax auditor would need to qualify the tax audit report, and the tax auditor would also evaluate how the statutory auditor has reported his particular matter in this audit report. Option D is most appropriate. Though they did not talk about the additional audit procedures, but they have skipped a bit, and this is most appropriate than all the above three to qualify the report, and then mention how the statutory auditor done. And third one is the management need to revise in respect of appointment of common auditor, both statutory and internal auditors. Okay, management has advised correctly. What they have advised? Okay, they are saying that management advised by a consultant that it cannot appoint statutory auditors as internal auditors because it would lead to issue of independence. Yes, internal auditors cannot be appointed as statutory auditors, but so that there could be your self-review threat. So yeah. The management has been advised correctly by the consultant. The statutory auditors cannot be appointed as internal auditors. Option A is correct. And please advise B associate whether it would be appropriate to drop management override controls and revenue recognition as significant risk. No, management overriding controls is a significant risk. It would cast a doubt on the integrity of the management. It would cast a doubt on all the written representations that were given by management and all audit evidence that were given obtained in the audit. That's a significant risk, and revenue recognition is also a significant risk. And we'll see the options here. It would be appropriate. No, it is not appropriate. Management overriding controls should continue to be significant risk. Yes. And here revenue may not be considered as significant. And no, this is wrong. And management overriding may not be considered as significant risk. No, option D is most appropriate. Both were should be continued as a significant risk. Now we'll move on with 17th case scenario. The first question is the balance of our bank, Indian bank with some Jewish bank, should be converted into Indian currencies at the following rate. Which rate? On the date of balance sheet date. The rate of balance sheet date. Option A is most appropriate answer. What should be the treatment of interest on deposits accrued but not due, appearing in financial statement? Interest that were accrued but not due have to be mentioned where? In other liabilities and provisions. Interest accrued on deposits and borrowings. On the amount due, that is 95, has to be shown under the head other liabilities and provisions. Option C is most appropriate answer. We'll see other options. Amount should be included in deposits amount. No, there is a separate heading for that. It has to be included in other liabilities and provisions. The amount should not be included in the amount of deposits. Yes, I think more B and C both were saying the same thing. So option D is most appropriate answer. And 13th one is the amount of interest swaps amounting to should be appeared in the financial statement as interest rate swaps. These were forward or derivative contracts, right? You see, under contingent liabilities, they were the liabilities on the account of outstanding forward contracts and derivative contracts with regards to the interest rate swap have to be mentioned under contingent liabilities. Option A is most appropriate answer. Which of the following is a correct statement relating to requirement of RBIs with SLR requirements? Okay. With regards to that, he has to verify the auditor. I think V and Associates is the auditor. Verify at the start and end of the year. No, has to verify the SLR requirements. 12 odd dates not being Fridays. This is the most appropriate answer, which we have discussed so many times. 15. With respect to the unaudited branches, what information the auditor required to disclose here? Number of audit branches, yes. The quantification of the advances, deposits, and interest income, interest expense of such unaudited branches also have to be given, yes. The quantification of advances amount exceed 5 CR, 2 CR. You see, we have learned the time limits and all with regards to that. But we haven't seen any kind of these limits with regards like quantifications of amounts that were less than hundreds here. So no provisions with regards to these 3 and 4, right? So 1 and 2 has to be given. Option A is most appropriate answer. While examining the computation of DTL, what have to be included? We have discussed it before also, right? See, inclusions in DTL is 3 items: net credit balance in branch adjustment accounts, that is, and adverse balance in nostro mirror accounts, interest accrued but not accounted has to be included in DTL. These part recoveries, these have to be excluded. Amount that was received in Indian currency, this is also related to exclusion. State credit balance in branch adjustment account has to be included. Option C is most appropriate answer. We'll see 18th scenario. First question. Auditor sought direct assistance from the internal auditor, advised whether he is permitted to do so or not. As he could do as per SS 16, auditor cannot ask for direct assistance evaluating significant accounting estimates, yes, and assessing the risk of material misstatement. That has to be done by auditor himself. They may assist in assembling information and resolve exceptions on confirmations and all. He could go. Option is most appropriate. We'll see other. Cannot assist in those assembling information, but can ask direct assistance in evaluating significant accounting estimates, no. And can ask direct assistance in evaluating significant estimates, no. Direct assistance in evaluating significant accounting estimates, no. Option A is most appropriate, that he cannot ask for direct assistance in evaluating significant accounting estimates and risk of material misstatements, but may ask for assembling information to resolve exceptions in confirmations. Second question is whether CAS is guilty of professional misconduct in providing private tutorship. Okay, teaching. He's doing teaching as per regulation 192E. 25 hours a week is general permission that was given. So how many hours he was doing? For 3 days a week, for 1 hour, just 3 hours a week. So he was not guilty. Not guilty as not exceeding 25 hours a month. No, it's week. The week here. Where is week? Yes, week. Not exceeding 25 hours a month as per 198. Option D is most appropriate answer. Question 3. Before signing the tax audit report, why send registered post to previous auditor and obtain post acknowledgement? You see, it's like communication to previous auditor before signing the engagement letter, before accepting, not before signing the tax audit report. What he is doing, right? Clause 8, Part 1, first schedule, that's right. Clause 8, Part 1, first schedule. Why will not be held guilty? No, he's guilty. Why not held guilty? Guilty. Why will be held guilty? Since he accepted the tax audit, yes. He has to communicate to previous auditor before accepting, not before signing the tax audit report. Option C is most appropriate answer. With the website designed, is in compliance with the guidelines or not. We have to see how he had built his website. He had built his website in a push model. No, it has to be like a pull model, right? He has to not push. And names of partners and major clients were displayed on website without any disclosure obligation from any regulator. How could he cannot disclose his client's name like that? Is that compliance? No, he didn't comply with that. No, as the names of partners of the firm of Magic were displayed without any disclosure obligation from the regulator. The regulator itself is saying there's no obligation to disclose the client's name and the partner's name. Why he is displaying that names and all? Option D is most appropriate answer. And now we'll move on with 19th question here. First question is whether the reporting of statutory operating procedure, that is SOPs, for logistic process are discussed in the scenario is required to be reported. Okay, what they are talking. Okay, we are internal auditors. Okay, SOPs for logistic process was not defined from point of vehicle request received to bills verification. That is whole sales process from the order to till bills verification. Okay, there's no proper internal controls here. SOPs or internal controls. SOPs were mostly like the rules and regulations that were given to employees how to operate. So since they were not there, SOPs were not there, it has to be highlighted. Yes, auditor should highlight and report this matter in his report. We'll see other options. This is not relevant for the management. No, design, implementation, and maintenance of internal controls is the responsibility of the management. And as it is underdeveloped, we don't want reasons for that what flaw. We want what the impact that it would give on our financial statements. As it's on the sales, we have to highlight that. So option B is most appropriate answer. And second one is contention of management about cash balance and insurance coverage plan. Comment on cash balance here. Cash in hand is higher than actual cash requirement from 7 to 84 times. Okay. The management explained that this occurred only during that specified period and the insurance coverage plan will be in next year. We don't want what all the future plans of the management. We want what the flaws that were done or what all the gaps in the SOPs or internal controls could have an impact on the financial statements. We are only concerned with that. And the only where we see is the management plans were while checking the going concern concept and not during the whole audit period. So the matter should be reported by the auditor. Yes, option A is right. And explanation given by management regarding pending delivery status to be shown. Okay, they have given few reasons why they were pending delivery status was not shown in the system. So this was an operational challenge and hence to purview of the internal auditor. Obviously, it comes under the scope of internal auditor because internal audit scope also consists of administrative activities. This is related to some system constraint and hence may be ignored by the internal auditor. No, the internal auditor needs to highlight in his report. Yes, the management should draw a proper plan to take care of this. We don't want any remedial actions later on. We want what has to be done by the auditor now. Option C is most appropriate answer. And whether the internal auditor is required to report regarding credit limit assessment. Okay, what's that talking about? Yes, it's observed that credit limit assessment was not being performed for all customers, which could result in possibility of the credit given to customers with a weak financial credibility leading to bad debts. Okay, there's a risk of bad debts that might happen for not doing credit assessment for all the customers or the vendors that we have been there. And the management replied that they started the process of updating the credit limit in ERP package, which shall be completed in a month's time. This is also under development. What we have to say when any kind of SOPs or systems are under development, we have to highlight that matter and highlight that matter. So since the management already taken remedial action, should drop the point. No, we are concerned about its impact on the financial statements, not about that. Or risk. It has risk of bad debts, right? And since the matter is related to financial, it should be covered by statute, not internal auditors. No. You see, internal audit scope includes both the financial statements, operating and administrative activities, and all that was done by the company. The management said the statutory auditors have also raised the point, hence internal auditor should drop the point. No, they should not restrict the scope, right? Internal auditor should report irrespective of the fact whether statutory auditors have covered or not. Option D is right. The management's plan to phase out the CA firm by building in-house internal audit team. Okay, we are audit firm, right? And they wanted to remove us and put an in-house internal audit team with their employees. And they are saying that audit team and has been questioned by statutory auditors saying this is not acceptable. Okay, statutory auditors were saying that this is not acceptable. Were they right? No, they were not right. An internal auditor could be employees or senior employees who has a limited knowledge, who has an experience with regards to the company's activities and all. Could be an internal auditor for that company. Even employees could be. Statutory auditor should observe for this for a period, and if they are working fine, they should have not a trial and error method. It's straight cut. They could accept. The management have discretion regarding this, and statutory auditors are not right. Yes, they have. Management has discretion that whether a CA firm should be there or a CA internal CA who is in employment or any other MBAs, CS, etc. Anybody could be an internal auditor. Option C, most appropriate answer. And now we'll move on with 20th case scenario here. First question. Shivam & Co. LLP submitted a list of its assurance and due diligence services in respect of selection of the engagement for the peer review. Okay, they have given list of their services that they are providing for peer review, but peer reviewer has to select only assurance services because that's only the scope under the peer review concept. Even if you think like or twice, like eligibility of the peer reviewer is also like 7 years of assurance services, right? Okay, that's an amendment there. Assurance services, not audit experience. That's so only the assurance services that comes under the scope of peer review and not due diligence. Here you have may select from and due diligence, no. Peer reviewer may select any sample out of assurance engagements, yes. Option B is most appropriate answer. You see, this is level 1, level 2 that had been amended with regard to phases, so that's irrelevant. We are not discussing that. Shivam also objected to the time taken by peer reviewer on site. However, as per the peer review, the review process got completed within 60. You see, as per the latest amendment for the May 2023, the review process has to be completed within 20 working days. If it's a new unit, the definition was also discussed, right? It has to be completed within 6 working days. Okay, so this is also a modification is required. This is not also not relevant for now. And in case of Shubham and associates, to improve upon the quality and strengthen the base, the board took the current member of the regional council as technical reviewer. No, as per the eligibility criteria of a technical reviewer to conduct a peer review, he should not be a member of the regional council. Yes, he should not currently be a member of the regional council. Option A is most appropriate answer. And in case of Shubham and Asisha, the reviewer raised on the observation that one of the audit team member signed the independence confirmation on date of audit report. You see, his independence confirmation and date of audit report is on the same date. It should not be that, right? The independence should be, the independence confirmation should be prior to the start of the audit or in between. There should be sufficient gap for the audit procedure. There should not be like this, right? So the observation of this reviewer is right. Option A is most appropriate answer.